for Wall Street, but for Main Street. And we've got you covered with Edward Lawrence on what the president wants to do to ease the pain at the pump. And our Susan Lee on an arcane number out today that you might not know, but the Federal Reserve sure does, that confirms.
Arcane, but important, because as you mentioned, it is the preferred read for inflation for the Federal Reserve. And the PCE is sitting at its highest in 40 years. So that pretty much gives the central bank the go-ahead for more aggressive interest rate hikes this year. So yes, a personal consumption expenditure index, PCE for short, pretty much in line with the consumer price index, or the better known CPI gauge, and both at their hottest and their highest since 1982. Now, if you're wondering, well, what's the difference and why the Fed prefers the PCE? Well, it's because it's a wider calculation. It uses the same data that goes into the GDP report. It includes healthcare costs that companies pay, takes into account all households instead of just urban ones, and it's less affected by wider price swings. But if you step into any supermarket these days, you can see it for yourself. Prices are up pretty much across the board, and the USDA now forecasting that prices for beef, chicken, eggs, fruits, vegetables are all going to go higher in the first half of this year. Now, rising prices and inflation is a #1 issue right now for U.S. adults in 2 recent polls by Gallup and Quinnipiac, especially for those making less than 6 figures. And households, oh, by the way, you have to set aside an extra $5,200 a year, or more than $400 each month this year, to cover the higher costs, according to one analysis. And those looking to buy a home right now, you're going to get some sticker shock, not only from record prices, but also skyrocketing mortgage rates, which just hit the highest since 2018. And Neil, those mortgage rates are spiking because the market and Wall Street anticipates much more aggressive action from the Federal Reserve to try to fight and bring down inflation.
Because it's running at a pace almost 3 times what they'd like it to be. So that aside, we're seeing the first signs that consumers are retrenching, right? In the latest period, barely spending anything more at all, 0.2%, a fraction of what it was just the prior month. How bad is this getting?
It's getting pretty bad, and we're expecting GDP to also slow down this year. Also trying to price in the unknown right now with that Ukraine-Russia invasion. This is really giving Wall Street headaches, and why we're looking at the worst start to the stock markets in many, many years, Neil.
All right. Thank you, Susan, for that. Well, then the issue becomes